that the dust has settled on the turmoil in the cloud space, with many of these stocks bouncing today, we've got to circle back to the group. Earlier in the show, I gave you my triage analysis of all the cloud names we cover, which ones you can double down on, which ones seem a little risky to me. And now I want to come back to another software company as a service, one that you've asked me over and over again since it came public last Friday. I got this all weekend, Cloudflare. All right, Cloudflare is a cloud-based web infrastructure play, and it managed to rack up a decent IPO price at 15, then surging to 18 at the open, and staying there before climbing another 3.5% today. It's a strong stock. So could this fresh-faced cloud stock be worth owning? I think we need to be very careful here about approaching new names, frankly. If Cloudflare had come public, say, just 6 months ago, when the cloud stocks were red hot, and there seemed to be no price investors wouldn't pay for these things, then maybe I would have felt a little more comfortable about recommending it. But lately, this market's gotten a lot less hospitable to the cloud cohort. Today's rebound accepted. In the current environment, I think you need to steer clear of something like Cloudflare, and I know a lot of you like it. Don't get me wrong, the company has an intriguing concept. Cloudflare's platform basically helps businesses run their websites, making them more secure, enhancing their performance, and eliminating the cost and complexity of managing lots of individual pieces of hardware. In the old days, you get all these services from separate on-premises software providers. Cloudflare bundles them all together into one easy-to-use platform that seamlessly allows you to adopt additional solutions, and that is so important. As the company sees it, they're disrupting multiple large enterprise software markets with their bundled approach. They're going after virtual private networks, VPNs, internal and external firewalls, web security, distributed denial of service prevention, intrusion, detection, application delivery controls, content delivery networks, domain name systems, advanced threat prevention, and wide area networking. Think of Cloudflare as a one-stop shop that's going after parts of the cybersecurity and content delivery software industries. Put it all together, management argues that they've got a $31.6 billion total addressable market, or TAM, that's growing to $47 billion by 2022. And that's without counting the new areas Cloudflare is trying to expand into, like storage, 5G, the Internet of Things. I mean, what can I say? It does feel like it's got everything going for it. Now, they don't sell user data. They don't try to compete with their customers. They just give them a simple, easy-to-use platform that can work with any major public cloud vendor. Cloudflare's neutral, like Switzerland. In fact, some would say they're a little too neutral. Last month, as the company was preparing for its IPO, they caught a lot of flack for providing infrastructure and security services for some of the ugliest destinations on the web, including the site where a number of recent mass shooters were radicalized. Cloudflare dropped them as a client right after the El Paso shooting. But this wasn't the first time they'd gotten in trouble for doing business with the most hated parts of and hateful parts of the web. So when I say they're neutral like Switzerland, I mean it in both the positive and negative senses. That concept works for me, but what about the financials? Okay, Cloudflare posted 43% sales growth last year. That's a deceleration from 2017. Although in the first half of this year, that number reaccelerated to 48%. That's not bad. How about the margins? There's some noise here. We'd like to see a smooth trend, but instead, Cloudflare had a huge across-the-board improvement in 2017, better gross margin, better operating margin, better free cash flow margin, followed by some major deterioration last year. In the first half of 2019, the margins have improved modestly, so they seem to be back on the right track for the moment.
All aboard!
The other thing that's tough to get a read on here, Cloudflare's free cash flow, which appears to be going in the wrong direction. After falling from negative $20 million to negative $78 million last year, it worsened again, down $39 million in the first half of this year. And that's a decline versus the first half of 2018. That's bad. That said, there are some real positives. Cloudflare's paying customers grew by 38% last year and 33% so far this year. Solid. Better still, the number of customers paying them more than $100,000 a year has been growing much faster, up 70% in the first half. Makes sense. Part of Cloudflare's pitch is that they can easily scale up their business. So if customers want to spend more, it's extremely easy for the company to give them exactly what they need. But there's the problem. When you compare Cloudflare to the rest of the group, it does indeed come up short. Remember that rule of 40 that I talked about? I mentioned it earlier in the show. The idea here is that if you're a software as a service company, your revenue growth plus your profit margin should exceed 40%. Anything below that threshold is suspect. The rule of 40 gives you two ways to win. You can lose a lot of money as long as you have rapid revenue growth, or you can have slow revenue growth as long as you're making a lot of money. But you can't pass with middling growth and not so hot margins. I've already told you about the companies that pass this test, but Cloudflare, it ain't one of them. The company's growing at a 48% clip, but its operating margin is negative 27%. Add those two together and you get 21%. When you look at all the cloud stocks that have come public this year, Cloudflare actually has the worst rule of 40 score. In short, Cloudflare may have a solid concept, but in terms of its financials, it lags behind the rest of the cohort. Now, that would be fine if the stock had a sensible valuation. But geez, Cloudflare sells for 28 times last year's sales. Even if we assume it will keep growing at roughly the same pace, that means it's trading at 15 times next year's back-of-the-envelope sales forecast. That makes a pretty darn expensive stock. All of our cloud kings are cheaper: Salesforce, Adobe, VMware, Workday, Twilio, Splunk, and ServiceNow. So I can't recommend Cloudflare up here. Bottom line, if you got in on this Cloudflare IPO and made a nice profit, take it. Good for you. I hope these guys can deliver spectacular numbers going forward that justify the stock's stratospheric valuation. Yes, parabola. But based on Cloudflare's inconsistent results over the past 18 months, the stock's just too risky for me, especially in a market that no longer worships at the altar of the cloud. Let's go to Jackie in New York. Jackie.
Hey, Jim. Thank you for your recommendation of Verizon and Twilio. They both made me over 10%.
Oh, that's nice. Thank you.
Well, listen, the question tonight is Chewy. So I got in on IPO day at $38. That stock has been trading down ever since.
Yeah.
With earnings coming out post-market tomorrow, do you think I should cut my loss or wait for earnings to rescue the stock?
Well, I mean, look, we think that Chewy is a great concept, okay? And so, therefore, you don't want to trade in and out and flit when it comes to Chewy. Do I know if this quarter is going to be good or bad? I have no idea. But I do like the concept very much. Let's go to Jerry in Illinois. Jerry.
Hey, Jim, booyah.
Booyah, Jer.
As a former Marine, we say hoorah, so hoorah to you and your team for a fine show and dedication to the small investor.
Well, thank you, and thank you for serving. Thank you very much.
Great, Jim. Jim, in early August, you recommended Health Catalyst,
right,
who recently launched an IPO. So you're very high on their strategic plan to provide a complex analytics to the healthcare industry, which sounded very promising to me as well. So after doing some of my own research, and after the stock dropped 9% from its high of $49, I took a minimal position of $45.10.
Okay.
But early in August, the stock dropped to $33
right,
from 27, about a 27% decline. Since then, it's moved back up to about $37 today. But it's off 18% from my entry price.
Right.
So, Jim, what's your recommendation?
Okay, Jerry, look, I think this is a really good company. I think these stocks really got hammered, all of them. It's just like a giant group move. But that said, I'm reiterating that I think Health Catalyst is a terrific company. I think you'll do just fine. No need to buy any more unless it breaks that low that it hit of $32. This is $37. Now, if you made some money on Cloudflare, I say good for you. But these guys are just too inconsistent for my liking. There's much more mad money ahead. Looking for an easy way to access the $9 trillion gold market? I'm talking to an under-the-radar company that's hoping to help. Then, there are two deals staring us in the face, and they are worrisome to the entire market. I'll point them out and tell you how to approach them. And all your calls are rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.